This episode is brought to you by TruAmerica Multifamily, one of the nation's leading multifamily investment firms, with nearly 60,000 attainable rental housing units under management. This month, TruAmerica celebrates its 13-year anniversary with a commitment to building better communities. On today's episode, Michael Cohen, managing partner at Brighton Capital Advisors, and Andrew Kirsh, co-chairman of Sklar Kirsh, both join Bob on the podcast.
Welcome to Building Better Communities. I'm Bob Hart, your host, and today I have two very distinguished professional real estate leaders here among us. Michael Cohen, live from Charlotte, North Carolina, the CEO and founder of Brighton Capital Advisors, and an expert in CMBS renegotiation and loan modifications. Next to him, I have the most distinguished attorney and good friend and former collegiate baseball player, Andrew Kirsh. Andrew, welcome, and Michael, welcome.
Thank you. Thanks for having us.
Thank you. I'm going to start with Michael, and we're going to set this up. Today we're going to talk about what's going on in the world of loan restructuring and defaults, how people can learn from these two gentlemen on what to do and what not to do, and to just discuss the dynamics of the markets and how it's going to affect values over the near term. So, Michael, tell us a little bit about your background. I know you've been in banking, particularly focused on CMBS for almost 30 years. You grew up in New York. You went to college in Boston, at Boston University. And then after working in New York for a while, you made your way to Charlotte, where it's really is a cumulative level of experience that you've gathered over that time that's led to this new venture.
Absolutely. I think being in, I always like to say that I've been in CMBS since God was a baby.
Before we knew what CMBS was.
Before CMBS was CMBS. I was there in the very beginning where it was the end of the RTC days. I had left business school. I moved to New York City.
Early 90s.
Early 90s,
yep.
91, and I got a job that they said, go down to Lehman Brothers are securitizing the Resolution Trust Company loans, corporation loans. And we started.
Some people may not know what the RTC is because we have younger viewers.
Sure. Back in the early 90s, when the savings and loan crisis occurred, it was really 89 to 91. Most of the issues were that a lot of the savings and loans weren't regulated and they were going out of business. And the only way to they had a lot of real estate loans on their portfolio. And you can sell real estate loans one by one, but it's a very arduous task, but you also need a lot of information. The problem is that back in those days there wasn't a lot of technology, there wasn't people weren't putting things on databases, and so everything was really handwritten things in files. And what they decided to do was really the guys at Solomon Brothers started this, is that they were securitizing in the beginning residential loans. And what that does is what you do is you package all of the loans and then you distribute the cash flows. And when you do that, it gives you're diversifying your income stream for different properties. So you can have a loss in a few of the properties, but the other properties are going to carry you on. And if you think about it, a perfect pool is an example, is 100 loans, all equal size in 50 different states, and they're comprised of multifamily and office and retail. So not one can't just hurt you. It would have to be a big thing to hurt you. So CMBS became a way of the market, of the lending market, being able to open up again for a lot of borrowers who couldn't find a loan in a traditional bank or insurance company matter.
But it was really a Wall Street invention.
It's a
Remember
Wall
in the
Street
90s, Ethan Penner was promoting it at Nomura, and Lou Ranieri was at the front end of it.
That's where I was. I was at DLJ. We started a company called Column Financial. That was a competitor. I could tell you that I remember being in a meeting, and probably it was 1992, and we had all of the groups that were starting these CMBS groups come in and sit in the DLJ offices because we wanted to talk about, okay, well, what's the rules and regulations? How should we structure these? What should we do to make a market here? So really starting to make a market. But really what this was doing, and I'm a realist. I'm a bricks and mortar guy. I'm a real estate lender who understands this part of the business. The whole objective here is to allow the borrower to come in to get a loan on that maybe didn't qualify for a loan at the bank or didn't qualify for a loan at the institution because either the borrower may have had an issue with their past or the loan had a particular issue that didn't make it a good whole loan.
So CMBS is looking toward the borrower, but also looking toward the property to see if they can stretch into whatever the
CMBS loans are CMBS loans. So for the bondholder, and a good question is who wants to buy these bonds and what do you do? Because really what you're doing is you're trying to get to a pool of about $1 billion of size. So that's big enough where you could sell these to institutional investors. So a life company or a pension fund who traditionally like to make one loan at a time found it that if they can buy a portion or a strip of the bond, right, that not only were they getting good yield from that or getting good returns from that for their portfolio, because remember a lot of them are trying to match up their liabilities with this income stream.
Right.
Because one of the things that you should know is that a CMBS bond has a prepayment penalty throughout. So it will
yield maintenance.
Well, it's called defeasance. You actually have to pay back the entire interest stream that you would have paid back. You can't prepay it without a penalty. And why they like that is that they can match their liabilities or all their obligations with a static income stream. A residential loan, for example, that goes and gets securitized, and those pools have no prepayment penalties. If your home loan comes due and rates get better, you go out and get a new loan and that pool disappears. In CMBS, you're kind of stuck with that loan for the next 10 years. But for the borrower, it also helped them because it created a way to maybe get a little more dollars than the bank or the life company wants to give you. It gave you what's called non-recourse. It wasn't a personally guaranteed. But except for a few things, if that were laid out, like if you had fraud or negligent or you environmental waste or you did something bad to the property, pretty much it was non-recourse. So you didn't have to worry about yourself getting sued.
So if you're contrasting for a minute, and I'm a multifamily guy, so I know a lot of CMBS is office and retail, and it does have some multifamily, but you have the agencies for multifamily that are consistently lending over decades with a mandate every year, putting out money. And for the most part, the banks do that as well, but the banks have been known to pull back. CMBS has to make a spread.
Correct.
To securitize. And there are periods where it's gun-ho.
Yep.
And then we see periods where it's dark.
Yep. And I can explain
Talk about that a little bit.
So I want to talk about the evolution of CMBS for a minute. When I started in CMBS, all the pools had to have a requirement of we had a 30% multifamily or more in every pool. Why? Because that's what the investors wanted to see, and the multifamily at that time didn't have a good exit like they do now with the agencies.
So you're saying 30% of the pools needed?
30% of the pool minimum had to be, 20 to 30% of the pool wanted to be multifamily product. Okay. As we went on and as the agencies got more strength and people in the multifamily business really started to mature, that's when the CMBS bonds would take on more retail, hotel, office. I remember going to, it was First Union at the time. It was my second job, and I said, well, we have a hotel in New York City. And they said, well, wait a second, we don't do those. And eventually it started to do it, and it became very big, obviously.
First Union was the predecessor to Wachovia, right?
To Wachovia, which is now Wells Fargo. I mean, now after that point, I mean, honestly, they were one of a great company, and they did wonders.
Too much securitization did not help Wells Fargo at all.
Well, yeah, I mean, look, I think
Wachovia.
Wachovia. I think what happens is that the CMBS isn't necessary for our capital markets to survive. It is a way to diversify risk and to sell into other, is to make loans and to diversify risk. You try to do that when you participate a loan, but when you have thousands of loans, you cannot do that. And so in a market where there's volatility is where you see the highest spreads that are going on associated or coupons going on with the CMBS loan, and that's direct. It's a direct relationship with what the investor is willing to pay in that current
And you
market.
really have a lot of different mouths feeding off the trough of that spread.
Yes.
You have the bondholders,
Correct.
the servicer, the special servicer.
So
And the originator takes the spread.
The way that the way that if you look at your coupon, the bond is really it's a waterfall structure. So when you contribute, you close $1 billion worth of loans, and you send it to the rating agency, and the rating agency does their own underwriting on each loan or a portion of the loans, and then makes some assumptions, and they'll say, we recognize $900 million of your $1 billion of being rateable securities. That's AAA. And if you go AAA, AA, single A, triple B, double B, single B, and then all the way
rated
down.
by Moody's
That's
and others.
rated by Moody's, Fitch, Kroll. That they rate it for you, and you need these ratings for the pension pension
To buy the
firms
strips.
to buy the strips.
Yeah.
So the way that it happens is it's a waterfall. So as everybody's making their principal and interest payments, first goes to the AAA, then goes to the AA, then goes to the single A, then goes down. So the AAA investor gets the lowest amount of return, while the bottom of the stack, the triple C or the C minus,
the most risky portion
the
of
most
the stack.
risky portion gets the biggest return because they're the last in line.
And this is why you need different levels of servicing.
You have correct. So the one thing I want to say is, this will clear it up, is the bottom of the the $100 million piece that I said wasn't recognized by the rating agency. Well, that's equity, and so that is called the mezzanine piece. It's called the B piece. It's a number of things, but that's the non-rated piece at the bottom. So while that is the riskiest of riskiest, because you're not even a bond. You're sitting there waiting for the bondholders to get paid, and whatever drops out is yours.
That's why a firm like Brighton comes into play. Let me shift to Andrew for a second. So Andrew, you're at the cutting edge of what's going on here in Los Angeles. You grew up here, and now you're running, along with Jeff, a very big law firm, and you're seeing all sorts of transactions across many property types. And I'm sure you're seeing some of your clients getting involved in loan workouts as well. Give us a little of your take on both the CMBS side and what you're seeing in the general loan space right now.
Sure. Well, this has been going on since, summer of 22. So we're almost in the third year of this dislocated market, where a good number of our inbound calls have been regarding loan modifications. And clients will call, although sometimes I feel like I can have a magic wand, there is no magic wand.
What are they looking for you to solve their problem?
Yeah, essentially they're looking to me to solve a macroeconomic issue, or if it's property specific, a micro specific issue. And so what I tell my clients is there is no script that fits all loan modifications. Every single loan mod is bespoke, and it's based on a number of factors. It's based on who the lender is, the extent of the relationship between the lender and the borrower, the property location, does the lender feel that the borrower is the best operator to get the lender paid whole? How much time left for maturity? Has the borrower added more equity to help the situation? How candid and forthright is the borrower? You take all those factors in, and that's how we end up with, hopefully, a positive loan modification result. And a lot of it is based on who the lender is, right? And the current condition of the lender.
But one of the challenges with CMBS, and this is why I think Brighton exists, among other reasons, is because when you're trying to negotiate a CMBS loan, you can't even get someone to pick up the phone unless you know who to call.
Correct.
And then it's hard to get their attention to begin with.
It is effectively 1-800-mortgage, and the system is really. CMBS was really built to be a static system. You make your loan payments, you pay off the loan, and you go away, and that's it. And the pool is done, and that's it. And you get another loan, and you go again. And to Andrew's point, where he's spot on is, there's a communication issue that happens because there's no relationship within the servicing groups. So.
The servicing hierarchy.
The servicing hierarchy. And I want to talk about that for a second.
Because the borrowers know who the originators are.
Correct.
But they don't know who the servicers are.
But the originators sold the loan. So when I worked at one of my major groups, Citi, UBS, Deutsche, Wells Fargo, they knew me. And they said, hey, Mike, well, can you help me? And I said, well, the loan is sold. It's sold into a bond. We sold all the loans. So I don't have any control anymore. Right. Who do I call? Well, you have a master, so there's a couple things. There's three components of people that the borrower can see, and it's kind of the tip of the iceberg.
You mean this ecosystem?
And the ecosystem, and from what we can see, we are viewed to really two particular groups, and then one is not really seen, and then the rest of it is not seen at all by the borrower or the attorney. So the first one is the master servicer. The master servicer is Wells Fargo, is KeyBank, Trimont. They're loan servicers, and they're your administrative servicers. There's the ones that are following the loan docs. They're making sure your reporting requirements are coming in. They're making sure your lock boxes are set up. They're the ones that are your administrator. If you recall when I just talked about that bottom piece, that special servicer piece. Well, you have a special servicer. Now that special servicer is the one that is either owns that bottom piece or is representing the owner of that bottom piece.
Is that the Midlands of the world?
That would be a Midland. Well, Midland can be a master servicer as well, but that is the more famous names you'd hear of is K-Star, which is KKR's group, L&R, which is Rialto.
We've seen Rialto in the headlines recently.
Sure, you're going to see a lot of
The Real
these.
Deal.
Yeah, we're going to get a lot
the
of
poster
these.
child for
again,
tough dealings.
So the special servicer. I'm going to finish this and get to that point.
All right,
that's a great
let's talk
point.
about that.
Because the special servicer is the one that will make the decisions either for themselves or on behalf of what's called the controlling class holder.
But they have no investment in the strip, or do they?
They can or they cannot. So the special servicer can either be the actual investor, like K-Star is KKR. KKR
Right, that's what I thought.
Owns the B piece, or that piece, and actually is the servicing arm for that.
It's kind of like when they sell Freddie K strips.
Correct. You're just you're an advisor for that. Midland doesn't own that strip, but it's being hired by whoever the investor is that holds the lowest bond. It's a little technical, and I don't know if we have to go there. I'll say this.
I mean, let me ask Andrew a question though. Where do you see some of the issues in this whole special servicing process from a legal perspective?
Sure.
And then we'll come back.
Yeah. Well, look, first, when a borrower is looking to modify their loan, the first thing that the lender is going to send to the borrower is what's called a pre-negotiation agreement or a pre-negotiation letter. And in that agreement, it's going to say all of our communications and conversations are essentially protected. Privileged. We have no obligation to modify your loan. And here's the key. If we incur any third-party expenses, appraisals, legal fees, and other due diligence costs, borrower, you're going to pay those fees whether we modify your loan or don't. And so with respect to your question on special servicing, there is a conflict of interest where the special servicer starts getting paid fees when the loan is in special servicing, if there's a default, whether it's a monetary or non-monetary, if there's a maturity default. And so the biggest complaint that we get from our clients is the length of time in which this process is taking, and that's because the special servicer is making fees during this default period.
And a lot of people aren't sensitive to that, and they just get frustrated.
There's two things. First of all, because we work with lawyers, and we're not lawyers. We speak to the business side on behalf of the team, which is the borrower and their counsel, which advises us. We give them advice, and they tell us the direction they want to go in. But the key for what if you look at my LinkedIn, and I will say this on every single time, is get to us, Brighton, or your attorney, 6 to 9 months prior to your loan maturity. Why? There is no quick answer. I just told you there's 2 or 3 different parties which have to make a decision, and they're not in a rush to help you. And everything, by the way, all the fees, just so everybody is clear, these fees are not ad hoc. These fees are not just made up out of thin air and they kind of see what they can get from you. When the borrower, there's something called the pooling and servicing agreement, which lays out the entire fee structure of what they're allowed. Here's why the negative for a CMBS borrower. You closed your loan. You have no idea who your B-piece buyer is going to be or your special servicer is. Are they going to be lenient or are they going to be hard? And you don't know when they sold that servicing strip to those B-piece buyer and the master servicer who buy the rights to service, you weren't part of the process of which they determined what the servicing fees were going to be. So we automatically know when you go into special servicing, as soon as you get in there, you're going to get a special servicing fee. I could tell you that right now. And
So the moment you unlock that door.
There, in CMBS 1.0, we call that after the Great Recession. We say those and the banks were illiquid and you just had a rush to get to a servicer. The key was to not pay your loan and get into default so I can get into the special servicer and I can cut a deal.
That was the basic strategy.
That was great. It's complete opposite today. Complete opposite. You do not want to do that. When you do that, and Andrew knows, you will lose. Just the fact that you have to sign this pre-negotiation letter says, I don't have any rights, you're going to lose all your money.
What was the switch that flipped? Because that was the technique.
Last time we were
cycle.
in a liquidity crisis. We're not in a liquidity crisis now.
Which is why maybe you're not seeing as many defaults.
We're not seeing as many. If you look at default rates of people that are slow to pay, it's 7% on CMBS pools is the highest rate that it's been of people not paying across the board. It's been the highest in 20 years.
Yeah, I think the difference between today and 15 years ago, because 15 years ago, every day I'd have a client say to me, okay, Andrew, I'm going to buy a pool of loans. We have 2 days of due diligence. I don't care what's in these loans. I just know I'm buying it so cheap. So just make sure there's no nuclear missiles pointed at me. I'm doing this deal, unless if there's a major impediment to doing it. I have not seen any of these portfolio loan acquisitions. We're buying loans, one here, one there, office. Usually.
You mean in this environment?
In this environment.
Same here.
Right?
We're doing our first bank REO right now.
Right. So we're not seeing what we saw.
We got a discounted payoff of an office building. And I will tell you that they're rare because right now there's nobody's feeling it, when you put a loan out into the marketplace. There's enough people that want one that will bid it up. There's also the gamesmanship of which you cannot see underneath the water level is the rest of the bond and the bond structure and the bond investors. And what you can't see from under there is they kind of play a lot of games with each other because the special servicers can get as much fees as they want, or they have an extended period of time based on the pooling and servicing agreement. They can hold the loan in special servicing for a very long time to get a lot of fees out. Second, they may not want to sell a property because maybe they say, or foreclose because maybe they're saying, this is great. You know, let's keep it alive. We'd like to keep it alive for a little longer. Maybe sometimes they foreclose on something that you didn't think they should foreclose on. There's no programmatic solutions. There's not a lot of rhyme and reason. What you try to do is you try to have somebody that's really, really good lawyer who understands this and understands, first of all, what your exposure is on recourse and any other things that you have for default. And the second thing is you need a really strong advisor to go in to build. What we do is we try to build out your pre-negotiated workout. We want to go to the servicer and say, this is how we want to do it.
So you're really, if this was the entertainment industry, you'd be the script writer.
Yes.
You're really doing the packaging.
Yeah, we're selling the script because because in the negotiation, and the lawyer is going to tell us how strong or how weak we have to be with it, or how aggressive or not based on recourse issues.
Yeah.
So you're teaming up with counsel.
100%. And we actually, I tell borrowers, because some of these clients, they'll say, okay, Andrew, you got to go guns blazing. Let's write strong worded letters.
But they don't
and
know
this and
what
that.
they're really
They don't know.
doing.
But like Michael said, first and foremost, I need to review the non-recourse carve-out guarantee and any guarantee documents to understand how expansive this guarantee
Or if
may
anybody
be.
tripped a minefield on any of that.
Correct.
Absolutely. And then, because if I'm on the front lines, then the lender is obligated to retain counsel, and now they're incurring fees, and it's what I told you before. Even if they don't enter into a loan modification, by the way, it's the worst of both worlds. There's no loan modification, and you have to pay the lender their legal fees.
So when you're dealing with an office building in New York or LA, it's already underwater $50 million.
Right.
Who's paying all
Well,
this
that's
stuff?
that's part of the thing. Is one of the things that we do is Brighton is we'll go in and we'll find the pooling and servicing agreement. So at least we start to outline what we want to do is prep the borrower and their counsel as to what to expect when you're going to go in there. We could tell you based on our current experience what certain servicers are doing and giving up and what they're not. We could tell you what the timing is. I will tell you that this timing is. It's the slowest moving train you'll ever be on. This is not a fast. This is the slowest thing you'll ever do. But by creating, it's all communication, and these servicers are extra busy. We just talked to a special servicer today that said in the last 3 weeks they've seen such an increase in the volume that they're up day and night. They're slammed. Well, what does that mean? That means that you better have, when you make a submission, the entire story that can be socialized amongst the master, the special, and the controlling class holder and all the decision makers. And you better have all the backup documentation, and you better be ready in one shot. Because if not, it's going to sit there for 3 to 4 weeks, and then you're going to get a call and say, I'm missing that document. And you start back at the front of the line. So there's ways to manage.
That's why
the
they hired
system.
Brighton, right, son?
Exactly.
Well, they should be
exactly.
hiring Brighton.
Well, I mean,
and Andrew, of course, too.
But that's all. My partner's a former lawyer that worked as a senior closer at Bank of America, closing these conduit loans and then in large loan special servicing. And I've got a woman that's worked 20 years in CMBS special servicing at Wells Fargo. So this is all we know. So we know the people, we know it, but you have to go through the process. There's no cutting corners here.
So that's one of the big messages we'll say that's coming out of here. There's a process, and you can't shortcut it.
Correct.
Unless maybe Andrew knows somebody down in the bottom of the special servicing loop.
If you come with a strong lawyer like Andrew, you know, enough people are a little nervous.
You know, these things with these special servicers, they don't network like the three of us. Nobody knows these people.
They're not networking.
No, they're in a basement somewhere.
Yeah, they don't. Let's all be realistic. They're in the business to make money. They got in this money. Yep. And they're not making it. They're making it actually for themselves.
This is not. You know, we are in the real estate business because it's a relationship business. Yeah. This is not one aspect of the relationship business, and that's why it frustrates people.
Correct.
You can't relationship out of this issue.
But
it's nearly impossible.
I'm going to say this as a CMBS originator head for the Southeast for 25 years of my career. there are people that recognize that this is not relationship and enjoyed the fact that they were getting a very full loan at a very good coupon, at very long-term interest only and non-recourse. Sure. And I think they're smart by doing it. The thing is this: CMBS is a real estate trust that is tax oriented, and it is very inflexible. And if you wanted to change 2 walls of a property because you said you could make the property value much 3 times X, it doesn't matter. You can't do that in a CMBS structure. So when you took on the CMBS loan, remember what I said in the very beginning, people are banking on the investors just want a stable cash flow for 10 years and then get paid off. So you're dealing with the inflexibility, and on top of it, you're dealing with these servicers who are driven to make fees. They have the servicing standard, so they're not all out to get you. They're not, and they are following the pooling and servicing agreements. You need to understand what you're dealing with, and doing it yourself without a lawyer, especially, is not advisable. You should not. This is. You could start talking. I'll say this too. Right. The master servicer is not your buddy. As much as you know them and they talk to you and they're telling you, they can make certain decisions, but they're limited based on that.
So as skillful as you are at Brighton, and you're a fiduciary to your client, who's the borrower, you always strongly advise to have counsel working right next to you.
We will not engage a client unless they have a counsel like Andrew or somebody else with them, because I don't know, because we can't represent
only
them.
Andrew. We don't need anybody else.
But honestly, the biggest thing is I have a fiduciary responsibility to protect my borrower in every facet of the way. And one of the ways is I don't want them to get sued, nor do I want them to have personal recourse.
That is the number one question you have to answer right away. What is the recourse exposure? And
CMBS is non-recourse.
It is non-recourse, but there are gradients of the non-recourse carve-out
carve-outs that can be triggered.
Yes. And
have you seen much of that?
In this cycle, we are seeing lenders be very aggressive of trying to fit through a carve-out and making it recourse, whether certain covenants were breached, whether, and it's not really fraud and waste. I'm not talking about that. I'm talking about these hybrid monetary covenants that could trigger recourse.
Gotcha.
And that we can't go in to determine how strong we can pound our fist on the table until we know what you have, what you've got.
So there's a big assessment process that you're going through.
The first thing we
long
do
before engagement.
The first thing we do when we talk to a client is we ask them about the property, and we talk to them about why do you think that this property needs more time. Right? That's the first thing we do. So the second thing we do is we say, did you talk to your attorney about certain carve-outs? The third thing we say is, are you willing to put money into your property to back this up if we can modify it?
If they say what carve-outs, you know you've got a big problem.
Or we never negotiated the carve-outs.
And a lot of clients are frustrated with the predicament they're in. But what Michael was saying previously, they entered into this loan because it was higher leverage, lower interest rates, non-recourse. They could have had a more relationship-oriented loan. It would likely have been recourse with a bank. It would likely have been lower leverage with an insurance company. So they got something for the pain that they are now suffering. And look, I'll analogize. I lost my home in the Palisades fire, so I can make this analogy. The people in the Palisades who spent more money on their got a more bespoke, custom insurance policy, they're done. They've gotten paid out. Those, like myself, who went with a State Farm or a similar insurance company where the premiums were a lot lower, now are dealing with the ramifications of being with a giant insurance company.
But sometimes that was the choice because of the lack of availability of enough carriers.
And
Sure.
and that honestly, it's
And then
sometimes in CMBS there's
Yep.
a lack of choice.
There's a lack of choice.
When you're
Yeah.
coming in now, the loan.
That's the brilliance of Wall Street that created CMBS.
100%. You're filling a gap.
Right.
You're
And
filling a gap, and
it's-
but you're making it easier for the investors. If you think about the reason I got into CMBS and the light bulb went off in 1992 is because I said, wait a second, I'm securitizing all these loans, these bad loans in RTC, and you couldn't sell these one by one. But wait, if you package them together, now you can have different investment groups. I can buy, if I have one loan and I'm an insurance company, I have one loan and there's a problem with it, I got to find somebody who wants that one loan. I'm going to take a loss or I'm not going to take a loss. If I've got a portfolio, I put the certificate in my drawer and I say, you know what, I'm done with this thing, and I go out and I sell it back again.
Let's take a step back, and I think, Andrew, you were probably still in college during RTC, I would imagine.
Or
High school?
Or high school.
Or high school, or playing baseball.
I was 12.
But let's contrast the thrift and loan crisis in the early 90s, where banks were taken over, or these thrift and loans, with the GFC, which was derivative related, to what we have now, which, what are we even calling it now? It's the interest rate crisis. We don't have a name for it yet.
I think what we have now,
Post-COVID
yeah, I
malaise
mean,
crisis?
look, each one of those, the first two were very driven by liquidity and market driven by need to survive.
Well, there was a recession in the 90s.
Right.
I mean, LA was in the toilet in
Yeah,
the early
so was
90s.
every other city.
Between the
Earthquake,
the
fire.
earthquakes, the fall of aerospace jobs, you name it, it was a bad scene here in the housing bubble. Then you had the great financial crisis, which was really a Wall Street thing that led to oversupply
Correct.
and weak borrowing
Right, and bond collapse.
and bond collapses.
And then this one really is, look,
But this one seems to be steadier.
because first of all, the government is in more control of this. The regulators
are.
Sorry, not the government. The regulators are much more control. During COVID, when COVID hit and everything shut down, it would have been very easy for them to say, okay, well, let's just dump all the bad loans right now. But they didn't want to create that smartly. Right. What I believe is that the regulators did a smart thing by letting private investors build their wealth.
Look at the criticism, though, that was taken during the COVID period where we infused a lot of capital into the system. But in many ways, that's stabilized. But now we're coming home to roost because we've seen inflation.
This is all part and parcel of us curing ourselves, and this is the ramification. I mean, nobody. When you have to get fixed or mended, nobody actually wants to be the one that's going to be that's going to feel the brunt result of it. And commercial real estate is feeling the brunt result because of two things. One, everybody talks about higher interest rate, but I'm going to go number one. There's a lack of capacity in commercial balance sheets right now because they're holding assets that are maybe performing, but they're definitely underperforming. But the regulators are not forcing them to sell them off their books.
No, but I would say that over the last 2 quarters, we've seen lenders step on the gas.
Exactly. We were talking about that earlier today at lunch, whether or not something has shifted. I just put an REO under contract. Tell us about what your observations have been.
Well, so I was just at a distressed real estate. I travel. The thing that I try to do is travel to a lot of different cities and talk to a lot of different people, because if you ask the same questions in every place, you'll pick up the themes. And I was just at a distressed real estate conference in San Francisco, and a lot of the theme was that a lot of the sales, though, that are occurring, and I'm glad to hear that there's more sales. I'm not in that side of the business. I'm saving borrowers, right? But a lot of it has been that the sales in the portfolios have either been very high-end sales where the bank is recouping close to par, And they're either doing that because they're putting better quality out, or because they're putting out because the market's bidding it up, but they're taking back cash, or the properties are so underperforming that they just want to get rid of them. So I guess the question again, and again, like you said, this is a bespoke market, and everything's moving in. What I tell my clients is everything's on the table right now because we don't know what's happening, and they don't know what's happening.
Well, we do know there's almost 150 billion coming due at the end of this year.
Yes. So this year it's interesting. In CMBS, there's a barbell this year of loan maturities, first quarter and fourth quarter.
SASB almost 100 billion, conduit almost 50.
Right. So that means that you now have to find, so SASB for everybody is a single asset, single borrower securitization. That meant either one large loan, like a big office building downtown worth 800 million, or it's a single borrower and they said, we have the $400 million worth of loans and we're the borrower on this. Why is that? Why that's an issue? Because there's, again, if we go back to capacity of balance sheets, there's not a lot of homes for this. So now you have to go out to the public markets, and now your interest rate is going to double, right? In many cases, in almost every case that you go out,
You can't even support the current interest rate they're at.
correct,
How are you going to support double?
you have to write a check. All these loans,
That's the rebalancing issue.
the rebalancing issue, and
But it's you know how many clients of mine are going to write that check, especially when
Well, there you go.
you know have outside investors and maybe it's a syndication and not a joint venture structure. Even in a joint venture structure,
right.
equity, they want to know: is there a light at the end of the tunnel? Is there a path? If we write this check, is 1 + 1 going to equal 3? They're not just going to write a check to not make money.
Your point
end of
is
the day.
so well taken, which is who's going to take the loss and when.
Yeah.
Right? Is it the bank? Is it the borrower? Is it a combination? Now, we are seeing loan modifications where we come in, where we have two types of clients when it comes to loan modifications. We have certain clients that they're in a trough right now that maybe the property should be in the 90% or high 80% occupancy. It's not, and they just came to a position where that it's the timing of what's
An
going
office
on.
building in downtown LA, it's not at 80%.
Correct.
No,
And
and
we
I'm
have-
doing several of those transactions.
We have-
Let's talk about LA.
Yeah.
Although this is a national podcast, let's talk about LA because we're here.
Yeah.
You've got almost, I believe, about 10 billion, almost 200 loans that are coming due at the end of this year, and about 70% SASB, 30% conduit. As it breaks down, more than half of those are below a 1:1 debt coverage. And their rates are kind of in that 5% range or lower. So what do you see now? What are you seeing? And what do you expect to see? Because a lot of it's office buildings.
I'm doing a lot of office work right now.
$3 billion is office. We just saw the Wedbush Center go under special servicing in downtown LA on Wilshire. That's the latest victim.
Yep. I've been working on a number of downtown LA, not just downtown West LA, Culver City adjacent. Now, you can't get institutional capital to go buy these office buildings, so it's private capital.
Yeah, we saw that in some of the deals. What, there was one building, the Aon building, was it?
I worked on that deal.
Yeah.
I represented the buyer.
And for like 100 million?
A little more, but price per foot, it was
like
record
$100
low,
a foot or something.
essentially, right?
What would it cost you to build it? $1,000 a foot if you could build it?
I represented a buyer of an office building, of a note secured by an office building in Denver. You ready for this?
In Denver. Which is
$40 a foot.
for the paper or the whole deal?
Well, we ended up foreclosing 3 months later.
What year? What vintage was it?
It was built in early 80s, significantly renovated during COVID, 25% occupied, and on a price per pound, my client, I even invested.
Was it a skyscraper?
24 stories.
Yeah, I'd say so for Denver.
Yep, downtown Denver.
For $40 a foot.
$40 a
The
foot.
fees would be more than that to get it out of the ground.
I know.
So somebody's is going to make some money eventually.
Well, and there is I mean, we're getting a little off topic, but I feel there is a trend of more velocity in the office tenant market.
Okay.
But
yeah, definitely.
Yeah, but
we're seeing New York fill in.
Sure.
Look at this Century City, West Side.
Absolutely. And look, downtown LA has its issues. Some of my clients will say, from a cash flow perspective, they're fine. They cannot refinance their debt because cap rates have increased so significantly, they don't know what to do.
Right, and they're stuck because of, the debt coverage test may be testing a 5 at a 7, which makes it even tougher. If their coupon doesn't matter what their coupon is, it's what the test is at.
Right.
So in that case, where you have a good borrower, you have a good property, you have a position where it's over levered, but in a couple of years, you think maybe there's a reason of which
there's a path.
There's a path, but that path is going to require a business plan. It's going to require equity, and it's going to require a smart borrower who can figure out how to make that happen. We go in, and the servicer in that case, in the special, is like, that's great. We want this to happen. I mean, most special servicers will say, we always make them out to villains, but they're not. We'll always make them out to say, all they would like to do is really get the loan paid off. And if they have the ability to extend you, if you go in with a business plan, if you show them that you're the best one to take this through, we've gotten extensions for a number of our borrowers across the country. We're agnostic to where it is and what it is. But we're very sensitive to who the borrower is and what your plan is and how much money you can put in.
Well, you also have relationships that carry forward from borrower to borrower. And I think there's a certain selectivity among your clients
100%.
that you're going to want to preserve those relationships and how you conduct yourselves with those servicers.
Well, I will say this, that I will treat every client is the same, and I'll treat them as
if Bob's your client.
Then I of course more red. I don't know how much more red the carpet could get, or white the glove could be, but
hey, we're in multifamily. We don't have these issues.
You're not going to be.
We look at this way. We look at this way. I'll say it the other way. I'm not going to represent a client that is going to lie, steal, or cheat or steal. I'm not going to represent somebody that doesn't have that. If somebody tells me the word hope in the conversation, they're probably not going to get it. I'm probably not going to engage them, because hope is not an action. And I say that sincerely.
As Morgan Freeman said in The Shawshank Redemption, hope is a dangerous word.
Hope is a dangerous word, but you know what? It is. If the key to success, and I think Andrew obviously does a great job of it too, is education. Because if I can educate you on what the risks are, is that you own properties. My job for you is always to try to take as many of the known risks off the table so that you can make an informed decision.
Well, I think not only are you doing that, and as we've talked about, the theme of our podcast is called Building Better Communities, founders and CEOs like yourself talking about their careers, but also what are you doing to give back? And that teaching aspect is a form of giving back.
And
you're saving blight as well.
Correct.
To keep deals out of foreclosure.
I think we have an issue. I think this is where we are. I think we've just gone from I think there's a couple phases. I think we went through the devaluation stage of commercial real estate, and I think we're settling down. I think that I've talked to enough leasing brokers. I think that leasing velocity is starting to level off. I think there's some AI tenants out there that will come in, but I don't think there's any behemoth that's going to come in, new tenants. I think there's a flight to Class A and A plus buildings. I think that B buildings can be saved because at the right price point, you're going to be at the right price point.
Sure, because they serve a different tenant.
Correct. You're going to be able, at a right price point, you could fill up any building.
Absolutely.
But now you're going to end up in. So now you're going to end up with a situation where you have buildings that are not savable. There's plenty of buildings that are I don't know if I think it's 85 that have asbestos. You can't just knock that down. So you have to come in and be creative.
Not today's environmental regulations.
Correct. And so you have to be creative by that. But, my goal right now is to really, and it is a little like fighting Big Brother. I want to be able to, so when you step to the table and you're negotiating with your servicer, that you and your lawyer have somebody who's sat on the other side of that seat, that they can say, you know what, then wow, we're talking to somebody that knows what we're talking about, and we make the playing field a little bit more even-footed.
We've been talking about the bad bank side of CMBS and loan workouts. What should smart borrowers be doing at the front end? What should they be paying attention to so that if things go a little sideways, they're better prepared by the way they've negotiated their documents and their covenants?
Sure.
We'll start with Andrew.
Look, right from the term sheet, right? I know this is almost a shameless plug, but too many clients of mine get me involved after the term sheet is executed. And now my hands are tied because these term sheets...
You're working backwards.
Yeah, these term sheets are not a 2-page, high-level loan amount, interest rate, maturity date, and you're done. These are 15, 20-page elaborate term sheets that have gotchas in there. When I was talking about before how a non-recourse carve-out guarantee can trigger into recourse, not because of what we think of a bad boy act, but because of a monetary act, blown covenants, issues of that nature, that's all in the language in the term sheet. And if you don't negotiate that right from the beginning, you're stuck. You've signed a term sheet, that language will be cut and pasted in your loan documents, and there's nothing I can do. So that...
I agree with that. I think. Look,
Bring in counsel early.
Bring in counsel early.
Pre-term sheet stage.
I'll tell you why. Right now, and I was on the other side of the fence for 25, 30 years of writing these term sheets on behalf of the institutions that I was with, and they were all quality, and they all have smart people. And the smart in today's market, CMBS loans that are going to get done are very good quality loans. And the ones that fit into the box, and like I think we said at lunch, we were talking about the last deal that went out was at 60% loan to value at a 6.8
For CMBS, that's unbelievable.
At a 10 debt yield. That means those are the cream of the crop because they couldn't find a home somewhere else. So that means that all these banks, when you're in that zone, you are very wanted because everybody can make money and close your deal and get it sold. So what you want to do is you want to have your counsel look at your term sheet because you want to, there's certain things you may want to negotiate up front and hold some feet to the fire. Now, a lot of these CMBS, I don't know if it's changed recently, I don't think it has, but almost all, about 6 months ago, I was at a conference in New York City and all the servicers said, or all the originating platforms said, "Hey, we need the B buyer to sign off on this before we can close this loan."
So, are you doing front end work with borrowers as well?
I hate to say it, I don't offer it as a service, but I'm kind of shocked when people aren't calling us up and saying, "Can you look over our shoulder at the docs?" Because about 30% of my business right now is administrative issues. And that comes from debt service coverage sweeps that should not have occurred because they calculated it wrong. That comes from I've got monies trapped into a TILC account. I've got things that are in my loan document that are unclear. Maybe they're a dangling sentence, or maybe they're just something that we didn't contemplate this happening. And that's a big thing about COVID, right? The loan docs were frozen in time when they were closed pre-COVID, had no concept of what happens if you have a pandemic.
Yeah. Well,
no one would have thought of that.
Yeah, you talk about debt service coverage ratio. The definition of cash flow is not evenly defined throughout term sheets, and how they apply certain cash flow and don't allow other cash flow can really decide whether you are going to be in compliance or not. One other thing. I would, when you're engaging a mortgage broker to source your financing, it's not just, okay, show me all of the CMBS options. You should look at the bank options, the life co options.
Absolutely.
Now, you may be paying more interest rate, you may have a recourse exposure, but you should have a matrix of all the different options so that you know what you're getting into.
So shop around with the right personal loan shopper.
100%.
Absolutely.
So Andrew, let's shift for a second because we're going to wrap up here in a moment. But you've been very involved in the Los Angeles community now. You grew up here. You started your practice here. Talk about some of the things that you're doing to build a better community.
Sure. Well, my community, the Pacific Palisades, needs to be rebuilt. And
That's a big one.
That is a big one, and we could have another podcast on the Palisades. This is a difficult time for LA, and it's a difficult time for West LA. We're at an inflection point where we're gonna have the Olympics in 3 years. We're gonna have the World Cup. Another Super Bowl, and the city needs help. And it's beyond just the Palisades. And I do feel, though, that since COVID, the city has improved in terms of homelessness.
It was going on a good track. Karen Bass was working hard to help solve the homeless problem, although it's almost an insurmountable problem. And I think we're starting to see less crime, more decorum in LA.
We are. I feel, though, that when you have an incident like the Palisades fire, and there's not enough emergency personnel, fire personnel, and police personnel, our priorities need to be realigned.
Back to basics.
Back to basics. Yeah. That government's main job is to protect us.
Yeah, to fix potholes, to protect us from crime.
Yeah.
Keep the streets lit.
And fight a fire.
And have the equipment at their disposal to do that, although this was a world-class fire.
It certainly was. And so what can I do? What have I been doing at a micro level? Well, my kids' school burnt down, and so helping them get relocated to an office building in Santa Monica, helping them rebuild in the Palisades. I'm part of the Palisades Community Fund in raising money for... There's so many victims, and I'm not talking about myself. I'm talking about the people, janitors and landscapers and
Blue and
gardeners.
gray collar victims that
Yes.
they're losing their trade or their customer base.
The barber shop owner. All their customers are gone because those customers have either left the state, left the city, or maybe other parts of the greater LA area. They can't just easily move, and those people are hurting. So the Palisades Community Fund...
They're not gig workers.
They're not. They can't work from their home, right? And so those people need help. I'm going to be fine. My neighbors are, for the most part, are going to be fine. There are people who have lived in their Palisades home that was built in the 50s and are underinsured because they didn't have a mortgage. Those people need help. And we're talking about well over 10,000 people who either lost their home or are displaced because of significant smoke damage. And so these people's stories are not being told sufficiently enough.
No, it seems to have fallen out of the media.
It has. It's
very harsh.
And so... I'm helping rebuild that community, and look, I love LA. It's a good song, right, by Randy Newman, but I do. And so my wife and I, after January 7th, had a decision. Do we stay in LA, or do we start over we could have gone anywhere in the world. We have options, we're blessed with options, with financial security. And in the end, both my wife and I said, we're gonna stay in LA, we're gonna raise our kids in LA, and we're gonna help make LA a better place.
Thank you for doing that, Andrew. So, little known fact that you're an accomplished baseball player. What did you play? Outfield or?
Yeah, center field for the Dodgers. Center field for Northwestern. But
and in high school you played as well.
And high school. But Bob, my true passion right now is coaching my son. And so I've got a championship Little League game, 8U at Cheviot Hills Park in about 10 minutes.
Well, it's a good thing you're close by. We're going to wrap up here. So, Michael, how do people find you? You're in Charlotte. But
we're nationwide. We're obviously Brighton Capital Advisors. We could find us through the website at BrightonCapitalAdvisors.com. We're on LinkedIn. If you follow us on LinkedIn, I post a lot of articles and information. I try to keep everybody informed. And if you go back over the 5 years since I started this firm and going into seeing, I pretty much have been telling you the same thing over the last 5 years. But my key is I'm on the front lines. So if you have a question, call me, let me know, email me. It's mcohen at brightcapitaladvisors.com. And contact your lawyers. We do a lot of marketing and work with lawyers. We got a lot of referrals from lawyers.
So you like lawyers? You're one of those few people that
I like lawyers because A, they're smart, and B, we got them working. If they're behind me, or they're in front of me and they're barking and they're helpful, I love them. I just don't want them to turn around and start barking at me. So yes, I love lawyers when they're behind us.
Deal-oriented entrepreneurial lawyers.
Correct.
Yes, transactional folks.
This is the time. As I said, everything's on the table, and honestly, if you've got the right team in place, you are going to do very well. People say, oh, it's not programmatic now, and everything's bespoke. There's advantages to being bespoke because when I started my career in doing CMBS loans, we had to be creative, and if we're creative now and we can write your script, that means you're going to come out to the optimal solution, because it's easier to take things off the table than put things on the table in negotiation. So,
spoken like a true director. Thank you both for being here. Really appreciate it. I thought this was a great discussion, and I think hopefully everybody learned a lot, including myself.
Thanks.
I appreciate being on. Thank you.
Thank you. Good to have you both.